Section 2.1, 2.3 Understanding the Efficient Frontier, Section 2, Building the Efficient Frontier, 2.1 Asset Return and Risk Analysis. Assessing historical asset returns and risks is an important step in investment analysis and portfolio management. By analyzing historical data, investors can gain insights into the performance and characteristics of different assets. Here's how you can assess historical asset returns and risks. Gather historical data. Collect historical data for the assets you want to assess. This data typically includes historical prices or values of the assets over a specific time period. You can obtain this information from financial databases, investment platforms, or reliable sources such as financial publications. Calculate returns. Calculate the historical returns of each asset. Returns can be calculated using the formula, return equals, ending value, beginning value, / beginning value. This formula measures the percentage change in value over the specified time period. Calculate the returns for each time period, example, daily, monthly, annually, to capture different levels of granularity. Calculate risk measures. Use statistical measures to quantify risk. The most common risk measure is standard deviation, which measures the dispersion of returns around the average return. Calculate the standard deviation of returns for each asset to gauge their historical volatility. Analyze risk-return trade-off. Plot the historical returns and risks of the assets on a risk-return graph. This allows you to visualize the relationship between risk and return for each asset. Typically, higher returns are associated with higher risks, but this relationship may vary among different assets. Compare assets. Compare the historical returns and risks of different assets to identify their relative performance and risk profiles. Consider factors such as average returns, standard deviation, and other risk measures like beta, which measures an asset's sensitivity to market movements. This analysis helps in understanding the performance and risk characteristics of each asset. Consider historical patterns. Examine any patterns or trends in the historical data. Look for cyclical or seasonal patterns, periods of high volatility, or any other recurring patterns that might impact future returns and risks. It's important to note that historical data is backward-looking and does not guarantee future performance. However, analyzing historical asset returns and risks can provide valuable insights and serve as a foundation for making informed investment decisions. Additionally, it's crucial to consider other factors such as economic conditions, market trends, and fundamental analysis when assessing investments. Calculating standard deviation, variance, and covariance of asset returns. To calculate standard deviation, variance, and covariance of asset returns, you need historical return data for the assets you are analyzing. Here's how you can calculate these measures. Standard deviation. Calculate the average return of the asset by summing up all the returns and dividing by the total number of returns. For each return, subtract the average return from the individual return. Square each difference obtained in the previous step. Calculate the average of the squared differences. Take the square root of the average squared difference to obtain the standard deviation. Standard deviation equals square root of average of return, average return, caret 2, variance. Calculate the average return of the asset as explained in the standard deviation calculation. For each return, subtract the average return from the individual return. Square each difference obtained in the previous step. Calculate the average of the squared differences. Variance equals average of return, average return, caret 2. The variance is simply the squared value of the standard deviation. Covariance. Gather historical return data for two assets, asset A and asset B, over the same time period. Calculate the average return for each asset as explained in the standard deviation calculation. For each return pair, A and B, at a specific time point, subtract the average return of asset A from the return of asset A, and subtract the average return of asset B from the return of asset B. Multiply the differences obtained in the previous step, one from asset A and one from asset B, together. Repeat the above steps for all return pairs and calculate the average of the products obtained. Covariance equals average of return of asset A, average return of asset A, return of asset B, average return of asset B. Covariance measures the relationship between the returns of two assets. A positive covariance indicates that the returns tend to move together, positively correlated, while a negative covariance indicates that the returns tend to move in opposite directions, negatively correlated. It's important to note that these calculations are based on historical data and provide insights into past performance and relationships. The future performance and relationships of assets may differ. Additionally, these calculations assume that the historical data is representative of future behavior, which may not always be the case. 2.2 Portfolio construction, exploring the process of combining assets to create portfolios. The process of combining assets to create portfolios involves several steps. Here's an overview of the process. Define investment objectives. Start by clarifying your investment objectives. Consider factors such as your risk tolerance, return expectations, investment horizon, and any specific goals you have in mind. This step helps you determine the parameters within which you'll construct your portfolio. Assess risk and return characteristics. Evaluate the risk and return characteristics of different asset classes and individual assets. Analyze historical performance, expected future performance, volatility, correlation with other assets, and any other relevant factors. This analysis helps you understand the potential risks and returns associated with each asset. Determine asset allocation. Asset allocation refers to the process of determining how much of your portfolio will be allocated to each asset class. The goal is to create a diversified portfolio that aligns with your risk tolerance and return objectives. Consider spreading your investments across different asset classes, such as stocks, bonds, cash, real estate, and commodities. The specific allocation will depend on your investment strategy, risk tolerance, and market conditions. Select investments within asset classes. Once you have determined the allocation to each asset class, the next step is to select specific investments within each asset class. For example, if you have allocated a portion of your portfolio to stocks, you would research and choose individual stocks or exchange-traded funds, ETFs, that align with your investment criteria. Consider diversification. Diversification is a key principle in portfolio construction. Aim to select assets that have low correlations with each other. By diversifying your holdings, you can potentially reduce the overall risk of the portfolio without sacrificing potential returns. Consider diversification across sectors, geographic regions, industries, and asset classes. Portfolio optimization. Employ portfolio optimization techniques to find the optimal mix of assets that maximizes returns for a given level of risk or minimizes risk for a desired level of return. Optimization involves applying mathematical models and statistical techniques to analyze the risk-return trade-off and identify the most efficient portfolios. This step may involve sophisticated software or the assistance of a financial professional. Monitor and rebalance. Once you have constructed your portfolio, regularly monitor its performance and make adjustments as necessary. Market conditions, asset performance, and your investment goals may change over time, requiring you to rebalance your portfolio. Rebalancing involves adjusting the asset allocation back to its target weights to maintain the desired risk and return characteristics. Review and adjust. Conduct periodic reviews of your portfolio to assess its performance and alignment with your investment objectives. Evaluate whether any adjustments or changes are needed based on changes in your goals, risk tolerance, or market conditions. The process of combining assets to create portfolios requires careful consideration of risk, return, diversification, and ongoing monitoring. It's important to conduct thorough research, seek professional advice if needed, and regularly review your portfolio to ensure it remains aligned with your investment goals. Analyzing the impact of asset allocation on portfolio risk and return. Asset allocation plays a significant role in determining the risk and return characteristics of a portfolio. Here's how asset allocation impacts portfolio risk and return. Risk, diversification. Asset allocation allows for diversification across different asset classes, such as stocks, bonds, and cash. Diversification helps to reduce the overall risk of the portfolio by spreading investments across assets with varying risk profiles. By including assets that have low correlations with each other, the portfolio becomes less susceptible to the performance of any single asset. The result is a potential reduction in portfolio risk. Risk-return trade-off. Asset allocation decisions directly influence the risk-return trade-off. Different asset classes have varying levels of risk and expected returns. Higher risk assets, such as stocks, have the potential for higher returns but also come with greater volatility. Lower risk assets, such as bonds or cash, offer more stability but lower potential returns. By adjusting the allocation to different asset classes, investors can tailor the risk level of their portfolio according to their risk tolerance and return objectives. Risk management. Asset allocation can be used as a risk management tool. By diversifying across asset classes with different risk profiles, investors can potentially mitigate the impact of negative events on the portfolio. For example, during economic downturns, bonds or cash investments may provide stability and act as a hedge against equity market declines. Return maximization. Asset allocation influences the potential returns of a portfolio. Allocating a portion of the portfolio to higher risk assets, such as stocks or emerging markets, can provide the opportunity for higher returns. On the other hand, allocating a larger portion to lower risk assets, such as bonds or cash, may result in more modest returns. The specific allocation depends on an investor's return objectives, risk tolerance, and time horizon. Diversification benefits. Asset allocation allows investors to benefit from diversification, which can enhance overall portfolio returns. By diversifying across asset classes that have low correlations, investors can potentially capture positive returns from different sources even if some assets underperform. Diversification can help smooth out portfolio returns and reduce the impact of individual asset volatility. Market opportunities. Asset allocation enables investors to position their portfolios to take advantage of market opportunities. Different asset classes may perform differently under various market conditions. By adjusting the allocation to asset classes that are expected to perform well in specific market environments, investors can potentially enhance portfolio returns. It's important to note that the impact of asset allocation on portfolio risk and return depends on various factors, including the chosen asset classes, the investor's risk appetite, market conditions, and the time horizon of the investment. Regular portfolio monitoring and periodic rebalancing are crucial to maintain the desired asset allocation and align with changing market conditions and investment objectives. 2.3 Efficient frontier calculation. Applying mathematical optimization techniques to construct the efficient frontier. Constructing the efficient frontier involves applying mathematical optimization techniques to determine the optimal portfolio allocation that provides the highest expected return for a given level of risk or the lowest risk for a desired level of return. Here's an overview of how mathematical optimization techniques can be used to construct the efficient frontier. Define the problem. The first step is to define the optimization problem. Specify the objective function that represents the goal of the optimization. In this case, the objective function could be to maximize the portfolio's expected return or minimize the portfolio's risk. Set constraints. Specify the constraints that the portfolio must satisfy. Common constraints include allocation constraints. Set limits on the minimum and maximum allocation to each asset or asset class. This ensures that the portfolio remains within predefined limits. Budget constraints. Specify the total investment budget or the sum of weights in the portfolio. This ensures that the portfolio allocation adds up to 100% or a specific investment amount. Risk constraints. Set limits on the maximum acceptable risk level for the portfolio. This could be expressed as a maximum value for the portfolio's standard deviation or a desired level of volatility. Return constraints. Set a minimum required return or a target level of return that the portfolio should achieve. Select optimization method. Choose an appropriate optimization method to solve the problem. Common optimization techniques used in portfolio construction include mean-variance optimization. This method, popularized by modern portfolio theory, MPT, maximizes the expected return for a given level of risk or minimizes the risk for a desired level of return. It requires estimates of asset returns, variances, and covariances. Linear programming. Linear programming techniques can be used when the portfolio optimization problem can be formulated as a linear programming problem, such as when there are linear constraints on asset weights. Quadratic programming. Quadratic programming techniques can be used and the portfolio optimization problem involves quadratic objective functions or quadratic constraints. Solve the optimization problem. Apply the chosen optimization method to solve the problem. This involves finding the optimal allocation of assets that maximizes return or minimizes risk while satisfying the specified constraints. There are various numerical optimization algorithms available, such as the Markowitz mean-variance optimization algorithm, the interior point method for linear programming, or the active set method for quadratic programming. Generate the efficient frontier, iteratively solve the optimization problem for different levels of risk or return to generate multiple portfolios. Vary the risk or return parameter, such as the target standard deviation or expected return, to obtain different portfolio allocations. The set of all optimal portfolios at different risk-return combinations forms the efficient frontier. Analyze and select portfolios. Analyze the portfolios on the efficient frontier to identify the optimal trade-off between risk and return. Investors can select a portfolio from the efficient frontier based on their risk preferences and return objectives. The specific portfolio choice will depend on individual preferences and the investor's risk tolerance. It's important to note that constructing the efficient frontier involves making assumptions and using estimates of expected returns, variances, and covariances, which may introduce some degree of uncertainty. Regular monitoring and updating of the portfolio allocations based on new data and market conditions are essential to maintain the optimal asset allocation and align with changing investment goals. Implementing mathematical optimization techniques requires expertise in mathematical modeling, optimization algorithms, and familiarity with portfolio management concepts. Seeking assistance from financial professionals or utilizing specialized portfolio optimization software can be helpful in applying these techniques effectively. Using mean-variance optimization to determine the optimal asset allocation. Mean-variance optimization is a widely used mathematical technique to determine the optimal asset allocation in a portfolio. It was introduced by Harry Markowitz as part of modern portfolio theory, MPT. Here's a step-by-step guide on how to use mean-variance optimization to determine the optimal asset allocation. Gather data. Collect historical data for the assets you want to include in the portfolio. This data typically includes historical returns for each asset over a specific time period. Additionally, you will need the variances and covariances of the asset returns to estimate risk, estimate expected returns, calculate the expected returns for each asset based on historical data or other relevant information, such as analyst forecasts or fundamental analysis. There are various methods to estimate expected returns, including historical averages, fundamental analysis, or statistical models. Calculate risk measures. Calculate the variances and covariances of asset returns to estimate risk. Variance measures the dispersion of individual asset returns, while covariance measures the relationship between the returns of different assets. These measures are necessary to quantify risk and diversification benefits. Formulate the optimization problem. Define the optimization problem by setting the objective function and constraints. In mean-variance optimization, the objective is typically to maximize the portfolio's expected return for a given level of risk or minimize the portfolio's risk for a desired level of return. The constraints include allocation constraints, example, minimum and maximum weights for each asset, and possibly constraints on the total investment amount or target return. Solve the optimization problem. Apply an optimization algorithm to solve the mean-variance optimization problem. The optimization algorithm will find the asset allocation that maximizes the expected return for a given level of risk or minimizes the risk for a desired level of return. Various numerical optimization techniques, such as the Markowitz mean-variance optimization algorithm, can be used to solve the problem. Generate the efficient frontier. Iteratively solve the optimization problem for different levels of risk or return to generate a range of optimal portfolios. Vary the risk or return parameter, example, target standard deviation or expected return, and solve the optimization problem repeatedly. The set of all optimal portfolios at different risk-return combinations forms the efficient frontier. Analyze and select portfolios. Analyze the portfolios on the efficient frontier to identify the optimal trade-off between risk and return. Investors can select a portfolio from the efficient frontier based on their risk preferences and return objectives. The specific portfolio choice will depend on individual preferences and the investor's risk tolerance. Monitor and rebalance. Regularly monitor the performance of the portfolio and make adjustments as needed. Market conditions, asset performance, and the investor's goals may change over time. requiring rebalancing of the portfolio to maintain the desired asset allocation and risk-return characteristics. It's important to note that mean variance optimization is based on historical data and certain assumptions about return distributions and risk measures. These assumptions may not always hold true in the future, and the optimization results are subject to estimation errors. Regular updates of data, risk estimates, and reassessment of the optimization results are necessary to ensure the portfolio remains aligned with the investor's goals and market conditions.